Hey, everybody. Welcome to another episode of Blue Collar Real Estate. I'm Greg Mayo.
And I'm Ryan Herget. Greg, we are nearing May 1st today. Actually, today is May 1st. And we've got to have a conversation about what is going on in the world today as we deal with now almost 45 days of this COVID crap going on. And I know everybody's, getting a little bit anxious out there trying to see what's going on. But how you been, man? How you holding up through all this?
I've kind of settled into a pattern. I mean, I really have, where I just do what I do now, and it's so different than it used to be.
Isn't that weird, though?
About this, huh?
Isn't that weird, though?
It is what we can adapt to and get used to, right?
Truly. And, one of those things that, you hear a lot is a habit takes 21 days to, build. Well, at this point, and which is not quite the truth, but we, I'll digress and leave that for another podcast day. But, after about 21 days, you're in these new rhythms and, habits, right? And it's like, I'm still getting up at the same time, but I'm just having to structure my day entirely differently in order to be productive. So it's just, you're absolutely right. It's after 45 days of doing this kind of 21-day cycles, it's like, oh my gosh, I'm kind of used to this now. And it's not all bad. It's very, very different, but it's not all bad. So
no, anyway. And it's funny. I just finished a Darren Hardy book right before all this started, where he talks about what you just said about restructuring habits and whatever. And I was thinking about that last night, but everybody keeps talking about the new normal, but yeah, for me now it's just normal. It's just what I do every day.
Yeah, no, it's very different how we do and conduct business. As an example, and not to digress on too big of a tangent here, but, just kind of diving into this a little bit deeper for some people that are maybe curious about, can I sell a house during this period, or should I consider buying a house right now? I want people to consider something, just looking at the numbers here in Indianapolis, we're 45 plus days. And, since things really went into lockdown mode here, but home sales, there was over 1,000, almost 1,100 homes that sold in the last 7 days, whereas there was less than 600 that came on the market. Those are good numbers. Those sales numbers have actually increased over the last few weeks versus decreased, as I was kind of, fearing that they would. So things are certainly moving forward. It's certainly a time of uncertainty, but speaking of that, let's kind of dive into some of that uncertainty with today's topic, because, we're at May 1st, as I mentioned a few minutes ago. A lot of people are getting into that point, if they didn't last month, asking themselves, should I make my mortgage payment or not? We felt it would be really, helpful to really bring in a subject matter expert here, and we thought who better than our sponsor, Stacey Mayo, to kind of talk about, what's this mortgage forbearance talk? What's it mean? And really just kind of break down the nuts and bolts. So tell us about that, Greg. What are we going to dive into today with Stacey? I'm super excited to have this conversation.
Well, as you know, you and I are not mortgage experts. And during this COVID nonsense, we'll call it, it seems like things with lending has literally changed just about every day, sometimes multiple times a day. And so you and I talked, and we decided it was important to help people understand sort of the CARES Act, how that relates to mortgage forbearance, and is that a good idea, and sort of all the nuts and bolts of that. And quickly, after a couple-minute conversation, I don't know about you, but I realized I was way, way out at the shallow end. And we have a sponsor, Stacey Mayo and the Scott Miller team at Ruoff, and we thought, let's bring her in and help break down some of the different nuances of this thing and let people get a little bit more information before they just decide, well, I guess I won't make my mortgage payment. It's free.
Right. No, and that's really the thing that I wanted to dive into with Stacey on this, and we'll bring her on here in a few minutes and, dive into this subject, step by step here. But, as we look at this, if you're struggling to make your house payment, yes, programs 1,000% exist for you. In fact, I've talked to a lot of people that have already started to get the, checks in the mail, if you will, that have already signed up for the mortgage forbearance program and are seeing some benefits to that. However, there are potential implications. There's certainly a lot of unknowns because of what you said a few minutes ago, Greg. Literally, lending guidelines are changing by the day at this point in time. And what that means to a borrower, somebody that's maybe considering buying a house now or 6 months down the road, here's what that means to that person is in order to get an FHA loan, okay, an FHA loan is one of the most popular loans here, in fact, across the country. It's, average price for an FHA loan here in central Indiana is about $225,000. And with that loan, in order to get that loan, you now with most mortgage companies have to have a 640 credit score, whereas just 60 days ago, you could have a 580 with most.
Right.
To get the exact same loan, that just jumped. I can't do math very well in my head, but that's about 60 points difference that now your credit score has to be to get the exact same deal. And Stacey can talk about that another time as well. But that's just what's changed, and that's evolving on a daily basis. And that impacts what I know is important to you and I, Greg, which is why we started this podcast, is to talk about real estate from all the different perspectives, not just a buyer, a seller, or a real estate agent, but all of those different perspectives and how it impacts things. So without further ado, let's kind of dive into that. Greg, what's the first subject, you think we should talk about when it comes to, bringing Stacey on and diving into all of this? I'll let you kind of lead the way with that.
Well, I think the first thing we need to do is start to unpack the CARES Act. And we've had some video difficulty on Stacey's end, but we've got her on audio, I believe. Stacey, you there?
Hi, guys. I'm here.
Awesome. Welcome, Stacey.
Thanks for having me.
All right. So you kind of heard us talk a little bit. Let's start with the CARES Act. Kind of unpack that for us. What is the CARES Act?
Well, the CARES Act, it stands for Coronavirus Aid, Relief, and Economic Security Act. It was introduced and passed in March, and it is relief for federally backed mortgages, meaning insured by FHA, USDA, VA, Fannie and Freddie. And all of those are potentially eligible for mortgage forbearance.
Now, okay, so let me back up for a minute, Stacey. You said something about Fannie Mae and Freddie Mac. What are those exactly for people that maybe don't know?
So Fannie Mae and Freddie Mac are essentially insured conventional. They are government-sponsored enterprises, GSEs.
So all these programs that we're talking about are in one way or another backed by the federal government, right?
Right.
Okay.
There may be forbearance programs for traditional conventional loans as well. But the CARES Act is specifically for those federally backed mortgages.
Yeah, I just had a quick deeper dive and Stacey, I apologize. I'm kind of throwing I love stats and numbers and just kind of, wrapping this in a nutshell. And maybe this off the top of your head. If not, it's no big deal. But if you had to guess, with all those loans, that are done here, maybe in just, central Indiana, but with Fannie Mae, Freddie Mac, FHA, VA, all of those government-backed loans, what percentage of loans, of all the loans that get done, would you say are those, out of 10 people or 100 people that get home loans here in Indiana, what percentage are those types of loans? So we know what kind of person we're talking about here.
Well, that's a great question. We see a lot of federally backed mortgages. I personally do a lot of VA, USDA, FHA, and Freddie and Fannie. I would say personally, and I'm only going to speak for myself personally, that most of the loans that I do, 90% are federally backed.
Wow. So we're talking about a big number of all of the people that probably have loans out there in the United States are probably impacted by this, or an overwhelming majority. Would you say that's fair?
Yeah, there's the potential, definitely.
Got it. Okay. No, sorry, didn't mean to skip a side note there. I was just kind of curious there. So, but I know you were going to kind of talk about next, Greg, and I'll just kind of keep talking because that's what I do sometimes. I'm sorry. But Stacey, let's kind of unpack that forbearance. Like, what is a mortgage forbearance? Like, what's that actually mean to somebody that's maybe struggling to make their payment right now or not sure if they should?
So, well, a mortgage forbearance is when your mortgage servicer, so either your lender or the company that manages your loan and who you make your mortgage payment to every month, they allow you to either pause or reduce your regular monthly mortgage payments for a limited period of time.
Got it. So let's kind of unbox that a little bit. So, either pause or reduce. What's that mean? If somebody pauses their mortgage payment right now, certainly those payments don't just go away, right? Does that mean that they get, tacked onto the back of a loan? What's that mean to somebody that's possibly considering doing that, where a mortgage payment may get paused or something like that?
Okay, well, let's back up just a little bit in regards to the CARES Act and how that relates to the mortgage forbearance. Under the CARES Act, if a borrower attests, meaning in other words, they truthfully declare that they have been impacted by the COVID-19 pandemic and they find themselves unable to continue making their regular monthly on-time mortgage payments, they have the right to request a forbearance for up to 180 days, as well as an extension of an additional 180 days. Now, the borrowers do have to contact their servicer or their lender to request the forbearance. And the lender may have additional questions. And of course, right now, they're probably experiencing a high call volume, and you may be on hold for a while and waiting to talk to a representative. But mortgage forbearance, you got to talk to your lender first, or your servicer.
So it's not automatic, is what you're saying.
Exactly. Right.
So you just said a bunch of things there that I'd kind of like to just kind of talk about. I know when we were kind of doing some show prep, for this earlier in the week, I had a chance to talk to a few of, my customers, and I wanted to share a few stories on everything that you just said there. But I was talking with one yesterday, actually, that has a loan that's now owned by Wells Fargo. And what she was telling me was that she was actually on hold for 52 minutes to just have a conversation with somebody. And this was just earlier this week that, she was having this conversation. So just to kind of reiterate a point that you said there, there is so many people, I think going back to what you said also, Stacey, is that how many people do have these types of loans, the Fannie, the Freddie, the, government-backed loans there's so many people on, having to wait hours on hold just to simply get some questions answered in some cases here. And she told me specifically 52 minutes is what she was on hold for that. So there's a lot to this. And I think that, I want to really encourage people to just ask questions, understand kind of what you're getting into, understanding what a mortgage forbearance is and what it's not. Because, I think that one of the biggest things is that, or misconceptions that people have is that, I can just not make my payments for a few months and nothing's going to be impacted by that. So I'd kind of like to talk about that next, if you don't mind, Stacey, is, what is this and what is it not, if you don't kind of mind telling us, a little bit more about that.
Wait a minute, I can answer that. It's free money.
Almost, right?
Oh, nay. Don't listen to that guy over there. No, and I have to laugh because that's one thing a mortgage forbearance is not. And that's why I was so excited that you guys asked on the show, because, for some people, especially if this is their first mortgage, they're not really sure what all these terms mean. I mean, the mortgage process, I'm here to educate, but in the end, it can be a very confusing time for some people, especially, like I said, if it's their first mortgage. So what a mortgage forbearance is not, it's not free money.
Right.
It's not a forgiveness of any loan or regular monthly payment due. So simply put, a forbearance is delaying the inevitable repayment of one's contractual financial liability or obligation. You're just delaying the inevitable. Nobody's saying, hey, you know what? You can't make your payment. That's all right. It's forgiven. It's not forgiven.
But does it, under the CARES Act, me as the borrower, the person with the mortgage, it does protect me from additional fees and penalties, or no?
Yes, exactly right. It does protect the borrower from any additional fees and penalties. However, the normal interest is still going to accrue on the loan. And that's something that we really do need to touch on that as well.
I think that's super important. Let's just kind of deep dive right there, if you don't mind, Stacey, on that point right there. So, let's just create a scenario here real quick, but, let's just say that you skip making your payment for, 3 months, right? Let's kind of dive into that. What's that mean actually to somebody that says, all right, you know what, things aren't too bad, but you know what, I'm a little worried about them getting tight here. So I'm going to just contact my mortgage service provider and see if I can get a 3-month forbearance here. What's that mean to somebody though, like dollars and cents wise?
And so accrued interest is interest that you've accumulated on the loan, but not yet paid to your lender. So your mortgage interest can accrue daily or weekly, depending on your loan type. And it's based on your loan's principal balance and your mortgage rate. Okay. So then we're going to go talk about some possible options. And you're going to hear me continue to say, your mortgage interest is still going to accrue. Your mortgage interest is still going to accrue. That's kind of a crucial point here. Mm-hmm. So different options that may be available to borrowers looking for forbearance.
And Stacey, just to jump in here for a second before we get into the different options, because you kind of hit this a minute ago. Each lender may vary in the options available, right? They're all not going to be the same.
Exactly. They're not. Honestly, guys, things are changing in the industry daily. As you mentioned earlier, Greg, sometimes more than once a day, twice a day. You hear me talk about it all the time. We are constantly getting updates and notifications of how things are panning out, and everybody's still just trying to figure out the pieces in the puzzle for this situation. Nobody's been in this situation before. This is not a 2007, 8, 9.
So today on the show, we're going to talk about 3 different options as far as exercising that forbearance. The first one will be a lump sum payment. Help explain that to us, Stacey. What does that mean exactly?
Lump sum payment is going to be, let me give you an example. Okay. So say you take a 3-month forbearance starting in May, and your regular monthly payment is $1,000. Say month 4, you're ready to get back on track. Therefore, in August, under this lump sum payment plan, you could potentially owe the $3,000 in missed payments plus your $1,000 regular monthly payment for a total of $4,000 plus accrued interest. So you're looking at having, an over $4,000 a month payment due in August. That's lump sum.
So that's definitely something that people need to be aware of, is if that's the option that they're getting in, obviously they may need time to save for that, et cetera. So I think that's pretty straightforward. That one makes sense. Let's kind of talk about, one of the next ones. What's kind of that next option, Stacey? What's that look like for you? If maybe, perhaps the payments are spread out, over, a period of time, what's that look like?
Okay, that's a good one. So if the option is presented to you where you can spread out your missed payments over several months, we'll use that 3-month forbearance again for easy math. So, your regular payments, $1,000 a month, you've missed 3 payments. That's a total of $3,000 in missed payments that you still owe. Month 4, you're getting back on track. Now you've got your regular monthly payment of $1,000 plus an additional $500 a month for 6 months to make up that $3,000 in missed payments. Again, plus accrued interest.
So that's just going to then pad somebody's payment an extra $500 a month. So, what I'm hearing you say is that person needs to be prepared for, a pretty substantial increase in their monthly payment for at least a limited period of time there in order to get that thing caught back up then. Is that what I'm hearing you say?
Yep, exactly. So you've gone from, for this example, $1,000 a month mortgage payment to $1,500 a month for a period of time.
Following the math here, and I'm like, okay, so I take the 3-month forbearance, and so far the two options I've got is either I pay $4,000 in the 4th month, or 6 months after I restart, I pay $1,500 a month. That sounds to me like, and I understand this is exists for people that truly need it, right? And there are people that do. We all need help in different ways during this crazy time. But I'm looking at this, and all I keep thinking so far is, man, if I can, I need to make my mortgage payment.
Right. And please know this as well. Each servicer, and they're different. It might not be a 6-month plan. It might be a 9-month plan, a 12-month plan. But you got to call them, you got to talk to them, you got to get your options and weigh those options.
Well, and I think you just hit the nail on the head there, Stacey. This plan is going to be different depending on who your service provider is. And we're just simply here trying to give, people some examples of what exists right now, of what we know does exist. And, again, this could be different. That's why it's so important to make that phone call. Unfortunately, probably set on hold for a little while, but ultimately have to have that conversation. And, but I couldn't agree more, Greg. If you can make your mortgage payment, keep things as normal as you possibly can right now, because without a doubt, going back to the whole subject, topic here, is there is no free money here, and a delay is going to cost you money at some point in time. So let's kind of talk about that third option, Stacey, just kind of, putting a bow tie on, some ideas here, for people, just to kind of paint a picture here. But, let's say that, your mortgage service provider allows you to, maybe extend the term of the loan. Meaning, okay, now instead of a 30-year loan, now it's a 30-year and 3-month loan, or a 6-month loan, whatever that period may be. What's that look like? Could you kind of, share an example of that if maybe everything just gets pushed to the tail end of it?
Sure, absolutely. Most of the government-backed loans that I do are 30-year term, though there are 15-year terms on certain loan types. So an example, say you've got a 30-year FHA mortgage and you're 5 years into your payments. With that forbearance, the missed payments plus the accrued interest are added to the end of the loan. So depending on how many payments that you've missed, that you've been allowed to miss, they're going to add that to the end of the loan. So instead of maybe now you're 5 years in and you've only got 25 years left, you're looking at 26 years or more of monthly mortgage payments, remembering all the while that the interest has still been accruing on those missed payments. So you're extending that term out.
So that could potentially be even more expensive, although less expensive up front. It could be a little more expensive in the long run, because of that accrued interest. And, I'd like to kind of hover over that word real quick, because we keep talking about accrued interest, and I think that that's a term that maybe isn't as common language for everybody that doesn't do this every day. Let's kind of talk about that real quick, because you've said that with each of these different types. What's that actually mean to somebody, Stacey, when we say accrued interest? Because again, it's not free money.
Right. So accrued interest is interest that accumulates on the loan, but it's not been yet paid to the lender. It can accrue daily or weekly, depending on your loan type, and it's based on your loan's principal balance and your interest rate.
Got it. So that's something that if your daily interest is costing you $8 a day or whatever it may happen to be in somebody's example, that's how much that's going to be then compounded over time. That's accruing. So what's maybe another example of that, because I know with a 30-year loan, that can be a little bit daunting or, difficult to wrap your head around. Is there another example of that you can share, Stacey?
The biggest example is student loans. I'm seeing student loans and forbearance. Every time I work with a client that's got student loans, and we're looking at their balances, and I see the credit limit at say $10,000, but their balance is $12,000, $13,000 because they've put their student loans in forbearance. They've chosen not to make those payments, or they couldn't for whatever reason. And so that interest is accruing on that balance. So at the end of that forbearance period, they wind up owing more than the original $10,000 that they borrowed. So not only has their debt increased, it didn't decrease. Right. And then the interest was still accruing, all the while they were, maybe trying to save some money for, again, whatever reason they couldn't make their payments or whatnot. Now they not only owe that original balance, they owe more because that interest that can continue to accrue.
If I take this forbearance, how does it or will it impact my credit score?
Under typical circumstances, yes. But under the CARES Act, a forbearance should not have a direct effect on your credit score necessarily. However, it may affect your credit risk.
Help me understand the difference between those two.
So credit score, a lot of people maybe follow their credit score on Credit Karma, or maybe their credit card company offers them a glimpse into their consumer credit score. Credit scores are made up of several different factors, one being credit history and on-time monthly payments. Your credit risk is related to the possibility of loss resulting from a borrower's failure to repay a loan or meet their contractual obligations. So either they have a low credit risk or a high credit risk. And so while under the CARES Act, a forbearance should not directly affect your credit score, it may affect your credit risk. In other words, you may be unable to qualify for a refinance. Interest rates continue to be low. It might help you in your financial situation to refinance right now. However, if you have taken part in this mortgage forbearance, you may no longer qualify for a refinance. You may not be able to qualify for a new loan. Say you want to sell your house, upgrade, downsize, but you have, taken part in this forbearance for, period of time, may not be able to qualify for a new loan.
So there are a lot of moving pieces and parts to this. As we kind of put a bow tie on this episode, are there any final thoughts you want our lenders? You're our lender. You have any final thoughts that you want our listeners to take away?
In the short of it all, the forbearance is there for people that truly need assistance. If you have the means to make your mortgage payments, then make them. But talk to your service lender, consult with a financial planner, know your options. Know if this is going to impact your equity on your home. Are you going to be in a negative equity situation? Are you going to have an increased debt to income ratio? Are you going to have delayed financial strain? Know your options, guys.
I think that's well said in a nutshell right there, is just explore your options, know what they are, and just know how your choices are going to impact you long term. And as long as you know that going in, then, certainly a mortgage forbearance could be the right fit for somebody. So check it out and decide what's best. So to kind of wrap this one up, Greg, is there anything else that we need to tackle? Or I think we've covered a lot on this episode.
Yeah, I think that's a lot of information. I want to thank Stacey for taking a few minutes and coming on with us and kind of unpacking some of these ideas and terms. The final thought and the most important thing, talk to your lender, your service provider, talk to a financial planner. And again, to just repeat what Stacey said, know your options.
Period. That'll wrap it. So we appreciate everybody's time, and thanks again for tuning in to the latest edition of Blue Collar Real Estate. I'm Ryan Herget. Thanks so much, everybody.